Which order block is truly valid, and why does the market react only to some order blocks? Hello to all you great traders and loyal followers. Today, we want to talk very simply and practically. First, we'll have a simple and understandable definition of an order block. Then, we'll go over the characteristics that distinguish a banking order block from other zones. And finally, we'll give a clear example so the concept becomes completely clear for you. So it doesn't matter whether you're a professional trader or a beginner, this video contains important points that can change the way you look at the market. But before we continue with the lesson, make sure to subscribe to the channel and like this video so you don't miss the upcoming videos. Now let's get into the main training.
An order block is a zone on the chart where banks and large financial institutions have placed heavy buy or sell orders. These orders usually form before a strong market move and indicate a significant change in liquidity flow. When price returns to this zone, the remaining or newly entered orders cause a quick and strong reaction. That's why order blocks act like the market's memory and often lead to repeated similar behavior. For a professional trader, these zones are the best entry and exit points because behind them lies the power of big money.
But the main question is, which order block is valid and actually works in the market? Here, we are going to examine three fundamental principles, and the third principle is the most important and influential one among these three.
First principle: a valid order block must have caused a strong displacement in price. In other words, after the formation of the order block, we should see a sharp and rapid movement in price that eventually leads to a market structure break, or the same BOS.
Second principle: the order block must have collected liquidity before the move. If you don't have enough information about liquidity, be sure to watch our previous video. In this case, we can see that before the beginning of the main move, the market has collected the available liquidity in an area through a specific candle or movement in order to provide the necessary fuel for the next move. But the third principle, which is considered the most important one, after the order block, a fair value gap, or FVG, must be formed. The presence of an FVG indicates the entry of a large volume of orders and liquidity into the market and is considered one of the most important signs for identifying a powerful and valid order block.
Let's examine a real market example on the gold symbol so that this concept becomes clearer for you. As you can see on the chart, we have a very valid order block here. According to the first rule, after the formation of the order block, we should see a strong movement that eventually causes a market structure break, or the same BOS, and in this example, this has clearly happened. The second rule was liquidity collection. As you can see, before the main move, the candle before the order block has collected the liquidity available at an important level, and then the strong move has started. And finally, we observe the third rule, which is the formation of the FVG. This fair value gap indicates the entry of a large volume of orders and liquidity into the market, and when the price returned to this area for a retest, we witnessed an explosive and powerful movement in price. Well, friends, if this video was useful for you, be sure to subscribe to the channel, like the video, and share it with your trader friends so you don't miss the upcoming educational videos. I wish you successful and profitable trades. Goodbye.